Hello and welcome. Over the next several chapters, we will embark on a detailed journey to understand the complex and often turbulent world of cryptocurrency investing within the United States. Our goal is not to tell you what to do, but to provide you with a foundational understanding of the risks involved. This series is designed to be a map of the territory, highlighting potential hazards and points of interest, so that you can navigate more confidently on your own.
The information presented in this video is for informational and educational purposes only, and is not professional financial, investment, or tax advice. All cryptocurrency investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. Cryptocurrency investments are highly volatile and speculative. This video does not recommend investing in any specific cryptocurrency. Always do your own research and assess the risks before making any investment decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
For many, the world of cryptocurrency represents a new frontier of finance. It's a digital landscape filled with the promise of decentralization, technological innovation, and for some, the potential for significant financial returns. When you hear names like Bitcoin or Ethereum, you're hearing about the pioneers of this new age. They introduced the world to the idea of blockchain technology, a decentralized, distributed, and often public, digital ledger that is used to record transactions across many computers so that any involved record cannot be altered retroactively, without the alteration of all subsequent blocks. This technology is revolutionary. It offers a way to transfer value and information without relying on traditional intermediaries like banks or governments. This very concept is what draws millions of people to the crypto space. The allure is powerful. It's the idea of being part of a fundamental shift in how we think about money, ownership, and the internet itself. However, every frontier, by its very nature, is untamed and filled with risks. And in the world of crypto, these risks are not just present. They are profound and multifaceted. Understanding these risks is not just a good idea. It is the absolute first step anyone should take before even considering participating in this market. Throughout this series, we will dissect these risks one by one, from market volatility and regulatory uncertainty to security threats and sophisticated scams. Let's start with the most visible and perhaps the most well-known risk of all: extreme price volatility. If you were to chart the price of a traditional stock from a well-established company, you would likely see a line that moves up or down over time, but usually with a degree of relative stability. Now imagine that line on a roller coaster, with breathtaking climbs and terrifying drops happening not over years, but over months, weeks, or even within a single day. That is cryptocurrency volatility. It is not uncommon for a digital asset's value to surge by 20, 30, or even 50% in a short period, only to plummet just as dramatically soon after. What causes this? A number of factors. First, the crypto market is still relatively young and smaller compared to traditional financial markets like the stock market. This means that a single large trade, or a whale as they are often called, can have an outsized impact on the price. Second, the market is heavily driven by sentiment and speculation. News headlines, a tweet from a high-profile individual, or even rumors circulating on social media can trigger massive buying or selling frenzies. This is where human psychology plays a massive role. The fear of missing out, or FOMO, can cause prices to skyrocket as people rush to buy an asset that's rapidly increasing in value, often without understanding what they are buying. They are simply afraid of being left behind. Conversely, fear, uncertainty, and doubt, or FUD, can cause prices to collapse. A negative news story, a government announcement about potential regulation, or a security breach at an exchange can cause widespread panic, leading to a massive sell-off as people rush to exit their positions. This emotional roller coaster makes it incredibly difficult to make rational decisions. An investor might buy at the peak of a FOMO-driven rally, only to panic sell at the bottom of a FUD-induced crash, resulting in significant losses. This is a classic trap that has ensnared many newcomers to the space. It's a market that preys on emotional reactions. Therefore, understanding that this volatility is a core feature of the current crypto market, not a bug, is fundamental. Anyone entering this space must be prepared, both financially and emotionally, for the possibility of rapid and substantial decreases in the value of their holdings. Unlike a savings account or a certificate of deposit, there is no guarantee that the money you put into cryptocurrency will be there tomorrow. The value is not insured by the FDIC like US dollar deposits in a bank are. The principle of high risk for high potential reward is at its most extreme here. While some have realized incredible gains, countless others have lost substantial amounts of money, sometimes their entire life savings, by not fully appreciating the brutal nature of this volatility. So, as we conclude our first chapter, let us establish this as our foundation. The world of cryptocurrency is built on groundbreaking technology and offers a tantalizing vision of the future. However, it is also a landscape of extreme and unpredictable price swings, driven by a complex mix of technology, speculation, and raw human emotion. This volatility is the first and most immediate risk you will face. In our next chapter, we will move from the risks of the market itself to the risks posed by the rules that govern it, or in many cases, the lack thereof. We will begin to explore the complex and ever-evolving regulatory landscape in the United States, a critical factor that every single participant in the crypto market must understand. Welcome back. In our opening chapter, we established that extreme price volatility is a fundamental and unavoidable risk in the cryptocurrency market. Now, we turn our attention from the risks inherent in the market's behavior to the risks created by the rules that attempt to govern it. This chapter focuses on the regulatory landscape in the United States, a topic that is just as complex and arguably more consequential for the long-term future of digital assets. Once again, a necessary reminder. This discussion is for informational purposes only and does not constitute legal, financial, or tax advice. The regulatory environment for cryptocurrencies is constantly changing and subject to interpretation. Always consult with qualified legal and financial professionals to understand how regulations may apply to your specific situation. Unlike the traditional banking or stock markets, which have decades of established laws and a clear hierarchy of oversight, the world of cryptocurrency in the US exists in a state of regulatory ambiguity. There isn't one single government body in charge. Instead, a number of federal agencies are vying for jurisdiction, often with overlapping authority and differing views on what cryptocurrency even is. This creates a confusing and uncertain environment for investors, builders, and businesses alike. Think of it not as a single clear rulebook, but as a patchwork quilt of different rules, interpretations, and ongoing legal battles. Let's break down the main players in this regulatory maze. First, we have the Securities and Exchange Commission, or SEC. The SEC's primary mission is to protect investors and maintain fair and orderly markets. Their main point of focus is determining whether a specific digital asset is a security. A security is a tradable financial instrument, like a stock or a bond. If a crypto asset is deemed a security, it falls under a strict set of laws that require detailed disclosures and registration. To make this determination, the SEC often applies a legal framework known as the Howey test, which stems from a 1946 Supreme Court case. In simple terms, the test asks if there is an investment of money in a common enterprise with an expectation of profits derived primarily from the efforts of others. Many cryptocurrency projects, especially those that raised money through an initial coin offering or ICO, have come under the SEC's scrutiny for potentially violating securities laws. The key takeaway here is the uncertainty. The debate over which digital assets are securities and which are not is one of the most significant, ongoing battles in the crypto space. The outcome of these legal challenges can have a massive impact on an asset's price, its availability on US exchanges, and the viability of the project itself. Next is the Commodity Futures Trading Commission, or CFTC. The CFTC oversees derivatives markets, such as futures and options. This agency has historically viewed certain well-established and decentralized cryptocurrencies, like Bitcoin, as commodities, much like gold, oil, or wheat. This classification is significant. While still regulated, commodities are generally subject to a different, and sometimes less intensive set of rules than securities. The tension between the SEC and the CFTC over who gets to regulate which assets creates a major source of confusion and risk. Then we have the Department of the Treasury and its branch, FinCEN, which stands for the Financial Crimes Enforcement Network. FinCEN's focus is not on whether crypto is a security or a commodity, but on preventing its use for illicit activities like money laundering and terrorism financing. Under the Bank Secrecy Act, cryptocurrency exchanges operating in the US are treated as money services businesses. This means they must register with FinCEN and comply with anti-money laundering, AML, and Know Your Customer, KYC requirements. This is why, when you sign up for a major US-based exchange, you have to provide personal information and verify your identity. These regulations are in place to ensure a transparent and legal flow of funds. Finally, there is the Internal Revenue Service, or IRS. From a tax perspective, the IRS has made its position quite clear. It views cryptocurrency not as currency, but as property. This classification has critical tax implications. Every time you sell, trade, or even use your cryptocurrency to buy something, from a cup of coffee to a car, you are technically disposing of property and creating a taxable event. You may be subject to capital gains tax on any increase in value from the time you acquired the asset to the time you spent or sold it. Keeping meticulous records of all your transactions is therefore not optional. It is a legal requirement. Failure to properly report crypto-related income can lead to significant penalties. We will not go into tax strategy, but this fundamental classification as property is a risk that every US-based participant must understand. This complex web of federal agencies often leads to what is known as regulation by enforcement. Because there are few clear, congressionally passed laws specifically for crypto, agencies often establish new rules and precedents by taking legal action against companies they believe are in violation. This creates a climate of fear and uncertainty, as projects and investors are often unsure of where the regulatory lines are drawn until after an enforcement action has already been taken. To add another layer of complexity, regulation doesn't just happen at the federal level. Individual states have their own rules. For example, New York has its own rigorous BIT license framework that cryptocurrency companies must adhere to if they wish to operate within the state. This means a company might be compliant at the federal level, but still be barred from operating in certain states, creating a fractured market across the country. In summary, the regulatory risk in the United States is defined by ambiguity and fragmentation. Different agencies have different views, leading to jurisdictional conflicts. The lack of clear, proactive legislation results in a reactive system of regulation through enforcement actions. And on top of it all, state-level laws add another complex layer to navigate. This uncertainty is a powerful risk factor that can impact the value of your holdings, the platforms you can use, and the long-term viability of the entire ecosystem. In our next chapter, we will shift our focus from the risks posed by governments and markets to the direct threats aimed at individuals. We'll explore the world of cybersecurity, hacking, and the personal security measures one must consider in the digital frontier. Thank you for listening. Welcome to Chapter 3. In our previous discussions, we've explored the wild volatility of the crypto market and the confusing maze of the US regulatory system. Now we shift our focus from these large, external forces to a risk that is far more personal and direct: the security of your digital assets. This is the domain of hackers, scammers, and the simple, irreversible risk of human error. As always, we must begin with our important clarification. This chapter provides a general overview of security risks and concepts for educational purposes. It is not a complete security guide, and should not be taken as technical or security advice. The methods used by malicious actors are constantly evolving. It is your personal responsibility to conduct extensive research and take the appropriate measures to secure your assets. In the world of cryptocurrency, you will often hear the phrase, "Not your keys, not your coins." This is perhaps the single most important principle of digital asset security. To understand it, we need to briefly touch on what a key is. When you own cryptocurrency, what you truly own is a private key. This is a long, complex string of cryptographic data. Think of it as the ultimate password and the master key to your digital vault, all in one. It gives you the power to access and send your cryptocurrency to anyone, anywhere. Whoever controls the private key, controls the crypto. There are no do-overs and no forgot password links. This brings us to the first major security decision and its associated risk. Where do you store your crypto? And by extension, who holds your private keys? Broadly, you have two choices. The first, and most common for beginners, is to leave your assets on the cryptocurrency exchange where you purchase them. This is known as a custodial solution, because the exchange is acting as a custodian, holding the private keys on your behalf. The primary benefit is convenience. It's easy to log in, see your balance, and make trades. However, the risk is immense. You are trusting a third party with the master key to your funds. Historically, cryptocurrency exchanges have been prime targets for hackers. There have been numerous high-profile breaches over the years, where hundreds of millions, and sometimes billions, of dollars in customer funds were stolen. While major US exchanges have significantly improved their security, no centralized entity is completely immune to a sophisticated attack. If the exchange you use is successfully hacked, you risk losing everything, and there is often little to no recourse to recover your funds. You are also exposed to the risk of the exchange itself failing, freezing withdrawals, or facing regulatory action that locks up your assets. When you leave your coins on an exchange, you are accepting this counterparty risk. You are trusting them completely. The second choice is self-custody. This is where you take direct control of your own private keys, moving your assets off the exchange and into a personal wallet that you alone control. This is the embodiment of the not your keys, not your coins ethos. The advantage is clear. You eliminate the third-party risk of an exchange hack or failure. You and only you have control. However, this freedom comes with a heavy burden of absolute personal responsibility. With self-custody, you become your own bank. If you make a mistake, there is no customer service line to call. If you lose your private key or your backup seed phrase, a list of words that can be used to restore your wallet, your funds are gone forever. It is technically impossible to recover them. They are permanently lost in the digital ether. The risks of self-custody are numerous. Your computer could be infected with malware that steals your keys. You could fall victim to a phishing attack, a fraudulent email or website designed to trick you into revealing your sensitive information. Or, you could simply misplace the piece of paper where you wrote down your seed phrase. The security of your assets rests entirely on your own diligence. Let's explore a few common threats in more detail. Phishing scams are rampant. You might receive an email that looks like it's from your exchange or wallet provider, warning you of a security issue and urging you to click a link to verify your account. This link leads to a fake website that looks identical to the real one. When you enter your login details or seed phrase, you are handing them directly to a thief. Another significant threat is malware. Malicious software can be designed to monitor your clipboard. Imagine you copy a long crypto address to send funds to. The malware can instantly replace that address in your clipboard with the hacker's address. When you paste it into your wallet and hit send, you are unknowingly sending your funds to the wrong person. And because crypto transactions are irreversible, that money is gone for good. A more sophisticated attack is a SIM swap. In this scenario, a criminal uses social engineering to convince your mobile phone provider to transfer your phone number to a SIM card they control. Once they have your number, they can intercept any two-factor authentication codes sent via text message, allowing them to reset your passwords and gain access to your accounts, including your crypto exchange accounts. To mitigate these risks, the crypto community has developed various security practices and tools. You will often hear about hot wallets versus cold wallets. A hot wallet is any crypto wallet that is connected to the internet, such as a mobile app or a browser extension. They are convenient for frequent transactions, but are more vulnerable to online attacks. A cold wallet, often a physical hardware device resembling a USB drive, keeps your private keys completely offline. To authorize a transaction, the device must be physically present and activated. This concept of cold storage provides a much higher level of security against online threats, but it still relies on the user to safeguard the physical device and its backup seed phrase. In conclusion, securing your digital assets is an active, ongoing process that requires constant vigilance. Whether you choose to trust an exchange or take on the responsibility of self-custody, you are accepting a unique set of serious risks. Understanding the power of your private keys and the methods criminals use to steal them is not just important. It is essential for survival in this space. In our next chapter, we will build upon this foundation and delve deeper into the world of scams, fraudulent projects, and the psychological tactics used to part investors from their money. Thank you for listening. Hello and welcome back. In our last chapter, we delved into the critical importance of personal security and the concept of not your keys, not your coins. We explored the direct threats of hacking and phishing. Now we broaden our view to examine a different, more insidious kind of threat. Projects that are designed from the very beginning to deceive and defraud investors. This is the world of scams, Ponzi schemes, and the powerful psychological tactics used to manipulate them. Before we enter this territory, we must reiterate our foundational principle. The following information is provided strictly for educational and informational purposes. It is a guide to help you recognize potential red flags and understand common fraudulent patterns. It is not investment advice. Always conduct your own exhaustive due diligence and consult with a qualified financial advisor before making any investment decisions. The same features that make cryptocurrency so revolutionary, decentralization, anonymity, and the ease of creating new tokens, also make it a fertile ground for bad actors. Creating a new crypto token and a professional-looking website can be done with surprising ease, allowing scammers to construct elaborate traps for the unwary. Let's dissect some of the most common types of scams. One of the most prevalent and damaging is the rug pull. This typically occurs in the world of decentralized finance, or DeFi. The process is deceptively simple. A development team, often anonymous, creates a new token and a project around it. They market it heavily on social media, promising huge returns and revolutionary technology. They attract investors who buy the token and encourage them to deposit their funds into a liquidity pool, which allows the token to be traded. Once a significant amount of money has been invested, the developers execute their malicious code, withdraw all the funds from the liquidity pool, and disappear without a trace. The token's value instantly crashes to zero, and the investors are left with worthless assets. Another classic fraud, updated for the digital age, is the Ponzi scheme. A crypto Ponzi scheme often masquerades as a high-yield investment program or a sophisticated trading bot. It promises unsustainably high and consistent returns, for example, 1 or 2% per day. In reality, these returns are not generated by any legitimate business activity. Instead, the money from new investors is simply used to pay the earlier investors. This creates an illusion of profitability, which helps attract even more participants. However, these schemes are mathematically doomed. Once the flow of new money slows down, the entire structure collapses, and the vast majority of participants lose their entire investment. Closely related is the pyramid scheme. While Ponzis are centered on investment returns, pyramid schemes are focused on recruitment. Participants earn money primarily by recruiting new members into the program, who must pay a fee to join. In the crypto space, this might involve buying into a specific token or platform. The focus is always on bringing in more people, not on any genuine product or service. Like Ponzi's, they are unsustainable and inevitably collapse. A well-documented historical example of a scheme combining elements of both was BitConnect, which collapsed spectacularly, resulting in billions of dollars in losses and numerous legal actions. Next, we have pump and dump schemes. These are common with very small, low-volume cryptocurrencies. A group of individuals will secretly accumulate a large position in one of these obscure tokens. Then they begin a coordinated and aggressive marketing campaign across platforms like Telegram, Discord, and Twitter. They spread hype, false news, and exaggerated claims to create a buying frenzy, the pump. As outsiders rush in, driven by FOMO, the price skyrockets. Once the price reaches a predetermined target, the original group sells, or dumps, all of their holdings at the inflated price, causing the value to crash violently. The latecomers who bought at the top are left holding the bag. Finally, a simpler but surprisingly effective scam involves impersonation and giveaways. You will often see these on social media. A scammer will create a fake profile that looks exactly like that of a famous entrepreneur, a crypto founder, or a well-known company. They will reply to a popular post, announcing a fake giveaway. They'll claim that for a limited time, anyone who sends a certain amount of cryptocurrency to a specific address will receive double the amount back. To create urgency, they'll say the offer is limited. Of course, any crypto sent to that address is simply stolen, and nothing is ever sent back. It's a straightforward theft that preys on greed and the trust people have in public figures. Understanding these scams is one part of the equation. The other is understanding why they work. Scammers are masters of psychological manipulation. They expertly leverage cognitive biases. They appeal to our deep-seated fear of missing out, FOMO, creating a sense of urgency that forces people to act before they think. They use overly complex, technobabble jargon to sound legitimate and to prevent you from asking simple, direct questions. Most insidiously, they often cultivate cult-like communities around their projects. In these groups, any form of skepticism or critical questioning is immediately shouted down and labeled as FUD. Fear, uncertainty, and doubt. This isolates members and discourages independent thought, making them more susceptible to the fraud. In this unregulated frontier, the familiar protections you might expect in traditional finance are often absent. The burden of verification and skepticism falls squarely on you, the individual. In our next chapter, we will discuss the tools and mindset required to navigate this challenging environment. We will explore the fundamentals of due diligence, the process of doing your own research, to better equip you to distinguish credible projects from potential traps. Thank you for listening. Hello and welcome to the 5th chapter of our series. In our last discussion, we navigated the treacherous landscape of scams and fraudulent projects. We identified the common patterns bad actors use to deceive people. That knowledge naturally leads to a critical question. How can one even begin to differentiate a potentially legitimate project from a well-disguised trap? The answer lies in a foundational principle of the crypto world, often abbreviated to 4 letters, DYWAR, or do your own research. Before we proceed, let's reaffirm our essential disclaimer. This chapter will provide a general framework for conducting research, and is for educational purposes only. It is not a formula for finding successful investments, nor is it financial advice. The process of due diligence is complex and does not eliminate risk. The responsibility for any decisions you make rests solely with you. Always consider consulting with a qualified financial professional. Do your own research is more than just a catchy phrase, it's a survival mindset. In a decentralized, largely unregulated market, there are no safety nets. There is no government agency that has vetted every project for you. The responsibility to investigate, question, and verify falls entirely on the individual. So what does this research process actually look like? Let's break it down into several core components. First, and most fundamentally, is the white paper. The white paper is the foundational document of any cryptocurrency project. It should be a detailed, technical document that outlines what the project aims to achieve. When reading a white paper, you should ask several key questions. Does it clearly identify a real-world problem? Does it propose a logical and coherent solution that genuinely requires a blockchain or a new token to work? Or does the use of blockchain feel like a gimmick? A strong white paper will be professional, well-written, and focused on technology and implementation. Red flags include white papers that are filled with vague marketing buzzwords, unrealistic promises of high returns, or sections that have been clearly plagiarized from other projects. Second, investigate the team behind the project. Who are the founders and developers? A credible project will typically have a public-facing team with real names and identities. You should be able to research these individuals. Do they have a proven track record in software development, cryptography, business, or a relevant field? Do they have active LinkedIn profiles or a history of work that you can verify? An anonymous team is one of the biggest red flags in the crypto space. While some legitimate projects have been started by anonymous founders, it is a significant risk. If the team is not willing to attach their reputation to the project, you must ask yourself why. If something goes wrong, they can disappear without accountability, just like in a rug pull. Third, you must understand the project's tokenomics, which is a blend of the words token and economics. This refers to the economic model of the cryptocurrency itself. Key questions here include: what is the total supply of the token? Is it fixed like Bitcoin's 21 million coins? Or is it inflationary, with new tokens being created over time? More importantly, what is the token distribution? How many of the tokens are held by the founding team and early investors? A large percentage held by insiders can be a major risk, as they could sell their holdings and crash the price. Look for projects where the team's tokens are vested, meaning they are locked up and released gradually over a period of years. This incentivizes them to work for the long-term success of the project. Finally, what is the token's utility? Does it have a clear use case within the project's ecosystem, such as paying for transaction fees, participating in governance, or accessing a service? A token with no clear utility is often a purely speculative instrument. Fourth, examine the community and social presence. A healthy project typically has an organic and active community of users and developers. Look at their official communication channels, such as Discord, Telegram, or Twitter. Is the discussion focused on the technology, development updates, and use cases? Or is the conversation almost entirely about price hype and speculation, phrases like, when moon, or when lumbo? A community that is hostile to critical questions or dismisses all skepticism as FUD is often a warning sign. Also, check the project's GitHub, which is a platform where developers post their code. Is the code being actively updated? This can show that a project is genuinely being worked on. Finally, it's crucial to be aware of your own psychological biases, specifically confirmation bias. This is the natural human tendency to look for, interpret, and favor information that confirms what we already believe. If you become excited about a project's potential, you might subconsciously start to seek out only positive news and ignore the red flags. To combat this, you must actively play the role of a skeptic. Deliberately search for criticism, negative reviews, and potential problems with the project. A balanced view, one that understands both the potential upsides and the significant downsides, is essential. In conclusion, doing your own research is not a quick or easy process. It involves a methodical investigation into a project's technology, team, economic model, and community. It requires a mindset of skepticism and a conscious effort to fight your own biases.
The information presented in this video is for informational and educational purposes only, and is not professional financial, investment, or tax advice. All cryptocurrency investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. Cryptocurrency investments are highly volatile and speculative. This video does not recommend investing in any specific cryptocurrency. Always do your own research and assess the risks before making any investment decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
It will not guarantee you will avoid all losses, but it is your single most powerful tool for navigating the risks we've discussed. In our next chapter, we will go deeper into the technology itself and explore the inherent technological risks of this space, such as smart contract bugs, network vulnerabilities, and the challenges of blockchain scalability. Thank you for listening. Welcome back. In our journey so far, we have examined the risks from market volatility, the regulatory environment, personal security threats, and fraudulent projects. In this chapter, we delve deeper, down to the very foundation of this entire ecosystem, the technology itself. Even the most legitimate and well-intentioned projects in the cryptocurrency space are built on complex, experimental code. And where there is code, there is always the risk of bugs, vulnerabilities, and unforeseen failures. As we begin this technical discussion, our standard disclaimer is more important than ever. The information presented here is for educational purposes, to provide a conceptual understanding of technological risks. It is not technical analysis or advice. The complexities of blockchain technology are immense. Always exercise extreme caution, and understand that interacting with this technology carries inherent risks that you are solely responsible for. The guiding principle in much of the crypto world is code is law. This means that on a blockchain, transactions and operations are often executed automatically and irreversibly according to the rules written into the code, without a central authority to intervene. While this is the source of blockchain's power, it is also the source of its most unforgiving risks. In the traditional financial system, if a mistake is made, you can often call a bank to reverse a transaction. On the blockchain, in most cases, there is no one to call. A mistake is final. Let's explore the first and perhaps most significant technological risk: smart contract vulnerabilities. A smart contract is a self-executing contract with the terms of the agreement directly written into lines of code. They are the engines that power decentralized finance, or DeFi, allowing users to lend, borrow, and trade assets without an intermediary. However, if there is a flaw, a bug, or a logical loophole in the smart contract's code, it can be exploited by malicious hackers. An attacker can use this vulnerability to drain all of the funds held within the contract. This isn't theoretical. It has happened countless times, leading to the loss of billions of dollars across the industry. One of the earliest and most famous examples was the DAO hack on the Ethereum network in 2016, which exposed just how devastating a single coding flaw could be. Even today, despite the rise of professional security audits where firms are paid to scrutinize the code, vulnerabilities are still found. An audit reduces risk, but it does not eliminate it. Next, there are risks at the level of the blockchain network itself. One of the most discussed is the 51% attack. Most major cryptocurrencies, like Bitcoin, are secured by a network of participants known as miners or validators. In a 51% attack, a single person or a coordinated group gains control of more than half of the network's total computing power. With this majority control, they could potentially disrupt the network. They could prevent other users' transactions from being confirmed. More dangerously, they could execute what's known as a double spend. This means they could send some cryptocurrency to an exchange, sell it for US dollars, and then use their network control to reverse the original transaction, effectively erasing the payment and keeping both the dollars and their original coins. Now, it is important to state that launching a 51% attack on a massive and highly decentralized network like Bitcoin is extraordinarily difficult and prohibitively expensive. However, for smaller, less established cryptocurrencies with less computing power securing them, this is a very real and documented threat that has been successfully executed in the past. Another critical technological risk is related to scalability and network congestion. You may have heard of the blockchain trilemma, a concept that suggests it is incredibly difficult for a blockchain to be simultaneously decentralized, secure, and highly scalable. Often, to maintain security and decentralization, networks have a limited capacity for how many transactions they can process at one time. During periods of high demand, a popular network like Ethereum can become severely congested, like a highway during rush hour. This results in two major problems for the user: extremely slow transaction times and exceptionally high transaction fees, often called gas fees. It's a risk of usability and cost. You might find yourself in a situation where a simple transaction could cost hundreds of dollars in fees or take hours to be confirmed. This can make many applications built on the blockchain impractical for the average user. Finally, we must consider protocol and upgrade risks. Blockchains are not static. They are constantly being updated and improved by their developer communities. However, upgrading a live, decentralized network that secures billions of dollars is an incredibly delicate and complex process. A poorly implemented upgrade could introduce new bugs or security holes into the very heart of the protocol. Sometimes, disagreements within the community on how to upgrade can lead to a contentious hard fork, where the blockchain literally splits into two separate chains, causing confusion and potential market disruption. In summary, the technology that underpins cryptocurrency is a double-edged sword. Its decentralized and immutable nature is revolutionary, but it also creates an environment where bugs in the code, flaws in the network design, and the inherent limitations of the technology itself can lead to sudden and irreversible financial loss. When you participate in this space, you are not just investing in an asset. You are placing your trust in the integrity of the underlying code. In our next chapter, we will examine the risks associated with the platforms we use to access this technology, the cryptocurrency exchanges themselves. Thank you for listening. Welcome back. We have journeyed through the technological risks coded into the very fabric of blockchains and smart contracts. Now we ascend a level to examine the primary gateways through which most people access this technology. Centralized cryptocurrency exchanges. These platforms are the bustling marketplaces of the digital asset world, but they are also centralized points of failure, introducing a critical category of danger known as counterparty risk. As we dissect these platforms, please remember our unwavering disclaimer. This discussion is for educational purposes only. It is not a review, rating, endorsement, or condemnation of any specific exchange or platform. The risks described here are systemic to the industry. You are solely responsible for any decision to use a third-party service and for understanding its terms and conditions. For most people, an exchange is their first and primary point of contact with crypto. They offer a user-friendly way to convert US dollars into digital assets, to trade, and to store holdings. But in providing this convenience, they ask for your ultimate trust. When you hold assets on an exchange, you are entrusting your private keys to that company. This creates several profound risks. The most obvious is the risk of hacking and security breaches. Centralized exchanges are massive honeypots, holding billions of dollars in assets, which makes them a top-tier target for the world's most sophisticated hackers. Throughout the history of crypto, there has been a long and painful list of major exchange hacks. While leading US-based exchanges now invest heavily in security, and may even have insurance policies, these protections are not absolute. Insurance coverage can have limits and may not cover all types of losses or all assets. The fundamental risk remains. A catastrophic breach could lead to the partial or total loss of customer funds. Even more devastating than a hack is the risk of insolvency and bankruptcy. This is perhaps the single greatest risk of using a custodian. Unlike the money you deposit in a traditional US bank, which is typically insured by the FDIC up to $250,000, the cryptocurrency you hold on an exchange generally has no such government protection. When you deposit your crypto onto an exchange, the legal structure of that deposit, as defined in their terms of service, can sometimes mean you are an unsecured creditor. In the event the company files for bankruptcy, you are in line with all other creditors, and often customers are near the back of that line. The painful history of the industry, with the collapses of platforms like MTGOX and more recently FTX, has shown that customers can lose everything or have their funds tied up in legal proceedings for years, with no guarantee of ever being made whole. Next, there is significant regulatory and legal risk. As we discussed in Chapter 2, the regulatory environment in the US is complex and constantly shifting. An exchange can find itself the target of an enforcement action from an agency like the SEC at any time. Such an action could force the exchange to halt trading of certain assets that are deemed to be unregistered securities, freeze withdrawals, or in a worst-case scenario, shut down its US operations entirely. In such an event, your assets could be locked up indefinitely, or their value could plummet due to the regulatory action. Through no fault of your own, you are exposed to the legal and regulatory standing of the company you choose to do business with. We must also consider the risk of technical outages and performance issues. Cryptocurrency markets are famously volatile and operate 24/7. It is during the moments of highest volatility, a sudden crash or a massive price surge, that you might most urgently want to access your account to buy or sell. Unfortunately, These are precisely the moments when exchanges are most likely to fail. Overwhelming traffic can cause websites to crash, apps to become unresponsive, and trade orders to fail. This inability to act during a critical market event can be the difference between a small loss and a catastrophic one. Finally, every user implicitly agrees to the exchange's terms of service, a lengthy legal document that very few people actually read. Buried within that text are clauses that give the exchange enormous power. They can, at their sole discretion, freeze your account, change their fee structures, halt trading on any asset, and amend their own rules with little notice. By using their platform, you are agreeing to play by their rules, whatever they may be, and whatever they may become in the future. In conclusion, while exchanges are a necessary and convenient tool for many, they are not risk-free vaults. They represent a trade-off. You sacrifice control for convenience. You introduce a massive central point of failure, and place your trust in the exchange's security, solvency, and legal standing. This reinforces the core ethos we discussed in a previous chapter. Not your keys, not your coins. Understanding the gamble you take when leaving assets in the hands of a custodian is a critical piece of managing your overall risk. In our next chapter, we will turn inward to explore the risks that come from within ourselves, the psychological biases and emotional pitfalls that can lead even the most informed investor to make poor decisions. Thank you for listening. Hello and welcome back. Thus far in our series, we have meticulously cataloged the external risks of cryptocurrency investing: market volatility, regulatory uncertainty, technological flaws, and the ever-present threats of scams and platform failures. Now we turn our focus inward to confront what is often the most dangerous and unpredictable variable in any investment equation: the human mind. The greatest risk may not be in the market but in the mirror. As we explore these concepts, please remember our critical disclaimer. This chapter discusses common psychological phenomena for educational purposes only. It is not financial, investment, or psychological advice. Understanding these biases does not prevent them, and you are solely responsible for your own decisions and emotional responses to the market. The cryptocurrency market, with its extreme speed and volatility, is a perfect storm for our inherent cognitive biases. Our brains evolved to make quick decisions for survival, not to rationally process global, 24/7 financial markets. Let's break down some of the most powerful psychological traps. First, and most famous, is FOMO, the fear of missing out. We've touched on this before, but it deserves a deeper look. FOMO is the intense, anxiety-driven urge to buy an asset simply because its price is rising dramatically, and you see others celebrating their gains. It's a powerful social contagion. Your rational mind is sidelined by the primal fear of being the only one left behind while everyone else becomes wealthy. This emotion typically peaks at the height of a bull market, compelling people to buy at the point of maximum financial risk, right before a potential crash. It is the engine of speculative bubbles. The dark twin of FOMO is FUD, fear, uncertainty, and doubt. FUD is the wave of panic that spreads during a market downturn. It's fueled by negative news, rumors on social media, or simply a sea of red in your portfolio. This fear can become overwhelming, causing an investor to sell their holdings in a panic, often near the bottom of a crash. This locks in their losses and prevents them from participating in any potential recovery. The destructive cycle for many is to buy based on FOMO at the top, and sell based on FUD at the bottom. Next is a more subtle but equally powerful bias: confirmation bias. This is our natural tendency to seek out, interpret, and remember information that confirms our existing beliefs, while simultaneously ignoring or dismissing information that contradicts them. For example, if you invest in a project you believe is revolutionary, you will subconsciously favor positive news, bullish YouTube videos, and optimistic tweets about it. You will likely label any valid criticism or negative analysis as simple FUD. This creates an echo chamber that insulates you from reality and prevents you from making an objective risk assessment. Then we have anchoring bias. This occurs when we rely too heavily on the first piece of information we receive. In crypto, a common anchor is an asset's all-time high price. An investor might see a token that once traded for $3 and is now at 50 cents. They anchor to the $3 price and perceive the current price as cheap, believing it will inevitably return to its former peak. This ignores the possibility that the project's fundamentals have deteriorated, and the old price is no longer relevant. Decisions become based on a historical anchor rather than a present-day valuation. A related phenomenon, especially potent with low-priced assets, is unit bias. Our brains have a strange preference for owning whole units of things. Many people would psychologically prefer to own 1 million tokens of a coin worth a fraction of a penny than to own 0.01 Bitcoin. Even if the dollar value is the same, the feeling of owning a million of something feels more substantial. Scammers often exploit this by creating tokens with a quadrillion units in supply to keep the price per unit astronomically low, attracting investors who mistakenly believe that a low unit price means more room to grow, completely ignoring the concept of market capitalization. Finally, we must be aware of the Dunning-Kruger effect. This is a cognitive bias where individuals with low competence in a particular area tend to dramatically overestimate their ability. In a crypto bull market, it's easy for a beginner to make a few profitable trades and feel like an investment genius. This newfound overconfidence can lead them to take on far greater risks, use leverage they don't understand, or invest their life savings, believing they have a special skill, when in reality, they were simply lucky in a rising market. These biases are not character flaws. They are deeply ingrained parts of human psychology. The goal is not to eliminate them. That's likely impossible. The goal is to be aware of them. By learning to recognize the feeling of FOMO, to question if you are only seeking confirming evidence, or to understand why a low unit price is seductive, you can begin to introduce logic and process into what would otherwise be a purely emotional decision. Managing your own psychology is one of the most advanced and critical skills in this arena. In our next chapter, we will look at the risks posed by the wider ecosystem, specifically the powerful role of social media and influencers in shaping market narratives. Thank you for listening. Hello and welcome. In our last chapter, we confronted the enemy in the mirror, exploring the internal, psychological biases that can sabotage our decision-making. Now we turn our gaze back to the outside world, to the digital environment where these biases are amplified and exploited on a massive scale. The world of social media. In cryptocurrency, information and more importantly misinformation spread not in days or hours but in seconds. As we navigate this topic, we must begin with our standing disclaimer. This chapter is an educational analysis of the crypto information ecosystem. It is not financial advice, and is not an attack on any specific individual or platform. The goal is to foster media literacy and a healthy sense of skepticism, which are your personal responsibilities to cultivate. Unlike traditional financial markets, which have established, regulated channels for information, the crypto market is a narrative economy. An asset's value is often driven less by fundamental metrics and more by the power of the story being told about it. And the primary arena where these stories are told, shaped, and spread is social media, on platforms like X, YouTube, TikTok, and Telegram. This creates a unique and potent set of risks. At the heart of this ecosystem is the rise of the crypto influencer. These are individuals who have built large online followings by creating content about cryptocurrency. While some may provide valuable insights, it is critical to understand the powerful and often hidden financial incentives at play. Many influencers are paid handsomely by crypto projects to promote their tokens. In the United States, regulations from the FTC and SEC require the disclosure of paid promotions, but these rules are often ignored or circumvented with a quickly flashed, barely noticeable hashtag. An influencer might present a glowing review of a project as their genuine opinion, when in fact, it is a paid advertisement. This leads to a severe conflict of interest. An influencer's primary goal may not be to provide you with accurate, unbiased information, but to please their sponsors or to increase the value of a token they were paid in. A particularly dangerous practice is when influencers are given a large allocation of a new token and then promote it to their audience. Their followers create the buying pressure, and the influencer then sells their own holdings into that manufactured demand, a practice known as using their audience for exit liquidity. It is also crucial to distinguish between information and entertainment. Much of the content created by influencers is designed to be entertainment. Bold predictions of a token going 100x, sensational thumbnails, and urgent, buy now calls are designed to maximize clicks, views, and engagement. Sober, balanced, and nuanced analysis is often less exciting and therefore gets less attention. Treating this entertainment content as serious financial research is a significant and common mistake. Social media platforms themselves are designed in a way that magnifies these risks. Their algorithms create echo chambers. As we discussed in the last chapter, our brains are prone to confirmation bias. Social media algorithms supercharge this. When you start to watch videos or like posts about a certain cryptocurrency, the platform's algorithm will feed you a constant, reinforcing stream of similar content. It will actively hide dissenting opinions and critical analysis. This can quickly create a powerful echo chamber where your positive belief in a project is amplified, and you become completely insulated from any potential red flags, making you more vulnerable to manipulation. This ecosystem is also rife with coordinated manipulation. Sophisticated actors use armies of bots to artificially amplify conversations about a token, creating the illusion of a massive, organic community. They can launch coordinated campaigns to spread FUD, fear, uncertainty, and doubt about a competing project, or spread fake news, like a non-existent partnership with a major company, to pump the price of their own holdings. Ultimately, you must learn to be a critical consumer of all online information. Ask yourself, what is this person's financial incentive for telling me this? Are they disclosing any sponsorship? Are they presenting a balanced view with potential risks? Or is it pure hype? Are they encouraging me to do my own research? Or are they creating a sense of urgency and FOMO? In conclusion, social media is an inseparable part of the crypto landscape, but it is a digital minefield. It is not a reliable source of unbiased truth. It is a battleground of competing narratives, hidden advertisements, and sophisticated psychological manipulation. Your ability to navigate it with extreme skepticism is a core survival skill. In our next chapter, we will zoom out even further to look at the macroeconomic risks, how broad economic forces like inflation, interest rates, and global events can have a profound impact on the entire crypto market. Thank you for listening. Hello and welcome to the 10th chapter of our series. We've journeyed through the internal workings of the crypto world, from its code to its culture of influencers. Now we must zoom out to the widest possible lens and understand that the cryptocurrency market, despite its decentralized ideals, does not exist in a vacuum. It is a small boat on a vast global economic ocean, subject to the powerful tides of macroeconomic forces. As we begin this broad discussion, we must anchor ourselves with our essential disclaimer. This is an educational overview of economic concepts and their potential impact on markets. It is not financial, economic, or investment advice. The relationship between macroeconomic factors and asset prices is complex and subject to change. All investment decisions are your sole responsibility. For many years, a popular narrative was that cryptocurrency, particularly Bitcoin, was an uncorrelated asset. This meant its price moved independently of traditional markets like stocks and bonds. However, as crypto has grown and attracted more institutional investment, this has proven to be largely untrue. Today, the crypto market is deeply intertwined with the global economy, and understanding this connection is critical to understanding its risks. The single most powerful force to be aware of is monetary policy, specifically the actions of the U.S. Federal Reserve. The Fed influences the economy primarily by setting interest rates. When the economy is overheating and inflation is high, the Fed raises interest rates. This makes borrowing money more expensive, which cools down the economy. For investors, higher interest rates mean that safer, traditional investments like government bonds offer a more attractive, risk-free return. This creates what's known as a risk-off environment. Capital tends to flow out of highly speculative, volatile assets, like cryptocurrency and tech stocks, and into safer havens. Conversely, when the economy is weak, the Fed lowers interest rates to encourage borrowing and spending. This makes the return on safe assets like bonds very low, pushing investors to look for higher yields elsewhere. This creates a risk-on environment, where capital is more willing to flow into high-growth, high-risk assets, which can be beneficial for the crypto market. Therefore, the decisions made by the Federal Reserve in Washington, D.C. can have a more immediate and powerful impact on your crypto portfolio than almost any news specific to a single project. This leads directly to the complex topic of inflation. One of the core narratives supporting Bitcoin is that its fixed supply of 21 million coins makes it a hedge against the inflation of fiat currencies like the US dollar, which can be printed without limit. The idea is that Bitcoin can act as a form of digital gold, preserving purchasing power over the long term. While this is a powerful story, the market's reaction has been more complicated. The very same high inflation that makes the digital gold narrative attractive is also what forces the Federal Reserve to raise interest rates. And as we just discussed, rising interest rates have historically created a risk-off environment that puts downward pressure on crypto prices. This conflict between the long-term narrative and the short-term market reality is a significant risk to understand. Another crucial risk is the increasing correlation with traditional markets. The idea that crypto would zig when the stock market zags has been a major selling point for diversification. However, especially in recent years, the crypto market has shown a strong positive correlation with the stock market, particularly the tech-heavy Nasdaq 100 index. This means that when the stock market goes up, crypto often goes up with it, but more importantly, When the stock market falls due to economic fears, crypto often falls even harder. This correlation risk means that cryptocurrency may not provide the diversification benefit that many investors expect, especially during a broad economic downturn. Finally, the overall health of the global economy plays a significant role. During periods of economic growth and prosperity, consumers and investors generally have more disposable income and a higher appetite for risk, some of which can flow into speculative markets like crypto. In contrast, during a recession, when unemployment rises and financial uncertainty is high, people tend to save more, pay off debt, and sell off their riskiest assets to cover expenses. This can lead to significant and sustained selling pressure on the entire crypto market. In conclusion, the days of crypto being an isolated digital island are over. It is now a recognized, albeit volatile, asset class that is highly sensitive to the decisions of central banks, the rate of inflation, and the overall health of the global financial system. A comprehensive understanding of the risks of crypto investing must now include an awareness of these powerful, external macroeconomic forces. In our next chapter, we will zoom back in and explore the risks unique to different types of crypto assets, from so-called stablecoins to the highly speculative world of meme coins. Thank you for listening. Hello and welcome to the 11th chapter of our series. We have explored the broad, systemic risks that affect the entire cryptocurrency market, from macroeconomic forces to the psychology of the crowd. Now we must zoom in and acknowledge a critical fact. Cryptocurrency is not a single entity. It is a vast and diverse ecosystem of digital assets, each with a unique design, purpose, and most importantly, a unique set of risks. As we dissect these categories, we must start with our foundational disclaimer. This is for educational purposes only. This information is not a recommendation to buy, sell, or avoid any specific asset or category of assets. It is not financial advice. The risks inherent in these different asset classes are significant, and you are solely responsible for understanding them. Let's begin with the backbone of the crypto trading world, stablecoins. A stablecoin is a type of digital asset designed to maintain a stable value, typically by pegging itself one-to-one with a fiat currency, like the US dollar. They serve as the essential plumbing for the crypto economy, allowing traders to move in and out of volatile positions without leaving the digital ecosystem. However, their stability is not a guarantee and comes with its own profound risks. There are two primary types. The most common are asset-backed stablecoins. These are issued by a central entity and are supposed to be backed 100% by reserves, such as actual US dollars held in a bank or short-term government debt. The risks here are about trust and transparency. First, there is reserve risk. Is the issuer truly holding $1 for every coin they issue? What is the quality of those assets? For years, this has been a point of contention, with investors having to trust the issuer's own reports. Second, there is run risk. A sudden loss of confidence in the issuer could trigger a mass redemption event, similar to a bank run, which could challenge the issuer's ability to honor all redemptions. To address this, the US government has taken steps. For example, the Fictional Genius Act of 2025 was designed to establish a federal framework, mandating that stablecoin issuers hold 100% liquid reserves and provide regular public disclosures to ensure consumer protection. The second type is the algorithmic stablecoin. These are far more experimental and dangerous. They are not backed by real-world assets. Instead, they use complex algorithms and a relationship with a second, volatile cryptocurrency to maintain their peg. The primary risk here is a catastrophic failure known as a death spiral. If the algorithmic stablecoin loses its peg due to market pressure, the system can enter a reflexive loop. The algorithm creates more and more of its partner token in a desperate attempt to stabilize the price, which causes the partner token's value to hyperinflate and crash to zero, taking the stablecoin with it. The historical collapse of the Terra UST stablecoin is the definitive and devastating real-world example of this risk, wiping out tens of billions of dollars in value in a matter of days. Now let's move from the most stable corner of the market to the most chaotic, meme coins. These are cryptocurrencies created based on internet jokes, memes, and online culture. It is crucial to understand that these assets typically have no underlying utility, no technological innovation, and no fundamental value. Their price is driven entirely by social media hype and speculation. The risks are therefore extreme. They are subject to hypervolatility, with prices that can surge thousands of percent, and then crash back to nearly zero just as quickly. They are also a breeding ground for scams, particularly the pump and dump schemes and rug pulls we've discussed previously. Participating in the meme coin market is not investing. It is pure gambling on social trends. Finally, let's look at non-fungible tokens, or NFTs. An NFT is a unique cryptographic token on a blockchain that represents ownership of a specific item, most commonly digital art.
The information presented in this video is for informational and educational purposes only, and is not professional financial, investment, or tax advice. All cryptocurrency investments involve risk, and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. Cryptocurrency investments are highly volatile and speculative. This video does not recommend investing in any specific cryptocurrency. Always do your own research and assess the risks before making any investment decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
The key word is non-fungible, meaning each token is unique and cannot be replaced by another. While they opened up a new world for digital ownership, they carry specific and severe risks. The most significant is illiquidity risk. Unlike a cryptocurrency you can sell instantly on an exchange, to sell an NFT, you must find a specific buyer willing to pay your desired price for that unique item. There is no guarantee a buyer will ever emerge. It is very common for an NFT purchase for thousands of dollars during a hype cycle to become completely unsellable, making its effective market value zero. Furthermore, valuation is highly subjective. The price of an NFT is based on artistic taste, cultural relevance, and hype, not on any tangible financial metrics. This makes the market prone to massive speculative bubbles. In conclusion, it is vital to look past the general label of crypto and understand the specific beast you are dealing with. The risk of a top-tier asset-backed stablecoin is entirely different from the risk of a purely speculative meme coin, which is again different from the illiquidity risk of an NFT. A diligent approach requires you to assess the unique risk profile of the specific asset class you are considering. In our next chapter, we will dive into the innovative but risky world of decentralized finance, or DeFi, where these different assets are put to work. Thank you for listening. Hello and welcome to Chapter 12. In our last discussion, we broke down the unique risks of different crypto asset classes. Now we venture into the arena where these assets are put to work in complex and often experimental ways. The world of decentralized finance, or DeFi. DeFi represents one of the most ambitious and innovative sectors of the crypto ecosystem, but it is also, without a doubt, its most hazardous frontier. Before we proceed, we must state our essential disclaimer. This chapter is for educational purposes only and provides a high-level overview of the risks associated with DeFi. It is not a guide, endorsement, or recommendation to use any DeFi protocol. The technology is experimental, the risks are extreme, and any funds you interact with in DeFi protocols are entirely at your own risk. So what is DeFi? At its core, DeFi is an attempt to rebuild traditional financial services, like lending, borrowing, trading, and earning interest, on public blockchains, primarily Ethereum. Instead of relying on centralized intermediaries like banks or brokerage firms, DeFi relies on self-executing smart contracts. The appeal is immense: a transparent, open, and permissionless financial system accessible to anyone with an internet connection. However, this radical new model strips away all the traditional safety nets, exposing users to a multi-layered set of severe risks. The most fundamental and pervasive risk in DeFi is smart contract risk. As we discussed in a previous chapter, a smart contract is just a piece of code, and code can have bugs. In DeFi, you deposit your funds directly into these smart contracts. If there is a single flaw, vulnerability, or exploit in that code, a hacker can potentially drain every last dollar from the protocol in an instant. The history of DeFi is littered with hundreds of such exploits, leading to billions of dollars in losses. Even protocols that have been professionally audited by security firms have later been hacked. An audit is a crucial step that can reduce risk, but it is never a guarantee of complete safety. Next, there is a significant risk from the developers themselves, commonly known as a rug pull. Many DeFi projects are launched by anonymous or pseudonymous teams. This creates a situation where the developers can build a hidden backdoor into the smart contract, or retain an administrative key that gives them ultimate control. They can wait for users to deposit a significant amount of money into their protocol, and then simply use their privileged access to withdraw all the funds and disappear. DeFi also introduces more complex, technical dangers like economic exploits and oracle manipulation. Many DeFi lending protocols rely on external data feeds, called oracles, to know the current price of different assets. If an attacker can manipulate that price feed, for instance by using a flash loan, to momentarily distort the price of an asset on a decentralized exchange, They can trick the lending protocol. They can fool it into thinking their collateral is worth much more than it is, allowing them to borrow and steal funds from the protocol. These are sophisticated attacks that exploit the very logic upon which DeFi is built. For users who try to participate by providing liquidity to decentralized exchanges, there is the unique and often misunderstood risk of impermanent loss. When you deposit a pair of assets into a liquidity pool to earn trading fees, the protocol automatically rebalances your holdings as prices fluctuate. If the price of one of the assets you deposited dramatically increases or decreases compared to the other, you can end up with less total value than if you had simply held your original two assets in your own wallet. The loss is the opportunity cost you paid for participating, and it can sometimes outweigh any fees you earn. Finally, there is immense regulatory risk. In the United States, the legal status of most DeFi protocols is a giant, gray area. Regulators like the SEC could potentially view them as unregistered securities exchanges or illegal lending operations. A sudden enforcement action against a major DeFi protocol could cause its native token to collapse, or could even result in the website used to access the protocol being shut down for US users, potentially trapping their funds. In conclusion, DeFi is the absolute cutting edge of financial technology. It is a space of incredible creativity and potential. However, it is also the Wild West, where the code is law, hackers are constantly probing for weaknesses, and there is no customer service, no insurance, and often no recourse when things go wrong. The combination of technical, economic, and regulatory risks makes it the most dangerous corner of the crypto universe. In our next chapter, we will focus on practical, operational security, the day-to-day habits and best practices for protecting your assets in this challenging environment. Thank you for listening. Hello and welcome to Chapter 13. After exploring the Wild West of decentralized finance, it's time to bring our focus back to the most critical line of defense in this entire ecosystem. We've discussed external threats from every angle, but they are all trying to breach one thing: your personal security. This chapter is about operational security, or OpSec, the practical, day-to-day habits and mindset required to protect your assets in a hostile digital environment. Before we outline these practices, we must deliver our most important disclaimer of the series. This chapter is an educational overview of common security concepts. It is not a foolproof security guide, and it is not technical advice. Security is a deeply personal and ongoing responsibility. Malicious actors are constantly developing new attack methods. No single set of practices can guarantee your safety. Any actions you take to secure your assets are entirely at your own risk. Operational security is not about buying a single product, it's a process and a mindset. It's about assuming you are always a target and taking deliberate steps to minimize your attack surface. The number of ways a thief can attempt to get to your funds. Let's begin with the front door. Securing your digital identity. Your first line of defense is your passwords. It is absolutely critical to use a strong, unique password for every single website and service you use, especially crypto exchanges. Reusing passwords is one of the most common and dangerous mistakes. If a non-crypto website you use is breached and your password is leaked, hackers will automatically try that same email and password combination on every major crypto exchange. To manage this, the concept of a reputable password manager is key. These tools generate and securely store long, complex, unique passwords for all your accounts. Beyond passwords, you must use two-factor authentication, or 2FA. But know that not all 2FA is created equal. The most common form, receiving a code via SMS text message, is better than nothing, but it is vulnerable to a SIM swap attack. A more secure method is to use an authenticator app, like Google Authenticator or Authy. These apps generate a time-sensitive code on your device itself, which is not vulnerable to a SIM swap. Next, let's discuss the master key to your self-custody assets, your seed phrase. The cardinal rule of seed phrase management is simple and absolute. Never ever, under any circumstances, store your seed phrase in a digital format. This means no text files on your computer, no drafts in your email, no notes in your phone, and no pictures in your photo library. If any of those devices are connected to the internet and become compromised with malware, your seed phrase will be stolen, and your funds will be gone forever. Your seed phrase should be written down physically, on paper or stamped into metal, and stored in one or more secure, private offline locations, protected from physical risks like fire, flood, and theft. Now we move to the most important component, the human firewall. This is your skepticism and your habits. First, be incredibly wary of phishing attacks. The safest habit you can build is to never click on links in emails, direct messages, or social media posts, even if they appear to be from a legitimate company. Scammers are experts at creating fake websites that look identical to the real thing. Always navigate to an exchange or service by manually typing the web address into your browser, or by using a trusted, previously saved bookmark. Furthermore, be mindful when signing transactions. When you interact with a DeFi protocol or an NFT project, your crypto wallet will pop up and ask you to sign or approve a transaction. This is you giving permission for the smart contract to do something. Malicious websites will try to trick you into signing a transaction that gives them permission to drain your entire wallet. It is vital to pause and, to the best of your ability, read what permissions you are granting before you click approve. When in doubt, reject the transaction. Finally, let's touch on your equipment. The concept of cold storage, using a hardware wallet, is a cornerstone of good OpSec. These physical devices keep your private keys completely offline, making it impossible for online malware to access them. When you need to approve a transaction, you must physically confirm it on the device itself, creating a powerful barrier against remote attacks. Also, practice good device hygiene. This means keeping your computer's operating system, your browser, and your wallet software constantly updated to ensure you have the latest security patches. Be extremely cautious about what browser extensions you install, as many have been found to contain malicious code designed to steal crypto. In conclusion, operational security is a continuous, active process. It is a mindset of vigilance, paranoia, and deliberate, methodical action. In a world without safety nets, you are your own bank, your own security guard, and your own last line of defense. In our next chapter, we will tackle one of the most complex and unavoidable risks for any U.S. participant: the risks and responsibilities of crypto taxes. Thank you for listening. Hello and welcome to Chapter 14. We have covered a vast landscape of risks, from the code itself to the psychology of the crowd. Now we arrive at one of the most complex, unavoidable, and high-stakes risks for any participant in the United States: taxes. The era of crypto being a financial Wild West, free from government oversight, is definitively over. Understanding your tax obligations is not optional, it is a legal requirement. This chapter requires our most forceful disclaimer yet. The following information is for educational purposes only to help you understand the framework the IRS uses. It is absolutely not tax advice, legal advice, or financial advice. Tax laws are incredibly complex and subject to change. You must consult with a qualified tax professional, such as a certified public accountant, CPA, who is experienced with digital assets, to understand your specific situation and ensure compliance. Making errors on your taxes can lead to severe penalties, interest, and legal consequences. The single most important concept to understand is this: for federal tax purposes, the IRS views cryptocurrency as property, not as currency. This classification, established in 2014, is the foundation for all U.S. crypto tax law. It means you treat your crypto assets much like you would treat stocks, real estate, or other forms of property. This classification as property is what creates a taxable event. A taxable event occurs when you dispose of your cryptocurrency. Let's look at the most common examples. First, selling cryptocurrency for US dollars. This is the most straightforward taxable event. If you sell your Bitcoin for cash, you have disposed of your property and must report any capital gain or loss. Second, and this is a critical point of confusion for many, is trading one cryptocurrency for another. If you trade your Ethereum for a different token, you have disposed of your Ethereum. This is a taxable event. The IRS views this as if you sold your Ethereum for dollars and immediately used those dollars to buy the new token. Third, using cryptocurrency to pay for goods or services. Whether you are buying a car or a cup of coffee, the moment you use your crypto to pay, you are disposing of property, and it is a taxable event. Fourth, earning cryptocurrency. If you are paid in crypto for a job, or if you earn it through activities like mining, staking rewards, or certain airdrops, this is generally treated as ordinary income. You must report the fair market value of the crypto in US dollars at the moment you received it. So, what isn't a taxable event? Generally, these activities do not trigger a tax obligation. Simply buying crypto with US dollars and holding it, donating crypto to a qualified 501c3 charity, gifting crypto to someone up to the annual gift tax exclusion limit, and transferring crypto between your own wallets, for example, moving it from an exchange to your personal hardware wallet. When you have a taxable event, you realize either a capital gain or a capital loss. The calculation is simple in theory. It's your proceeds minus your cost basis. The cost basis is what you originally paid for the asset, including fees. The critical factor for your tax rate is how long you held the asset. If you held the property for 1 year or less, it is a short-term capital gain or loss. Short-term gains are taxed at your ordinary income tax rates, which can be as high as 37%. If you held the property for more than 1 year, it is a long-term capital gain or loss. Long-term gains are taxed at much more favorable rates, which are 0%, 15%, or 20%, depending on your income level. This brings us to the immense operational risk of record-keeping. The burden of proof is on you, the taxpayer, to track the cost basis, the purchase date, the sale date, and the sale price for every single transaction you make. For active participants, this can mean thousands of transactions per year. Failure to keep meticulous records makes it impossible to file your taxes accurately. And make no mistake, the IRS is watching. Every U.S. taxpayer must now answer a question about their digital asset activity on the front page of the main Form 1040. Furthermore, starting for the 2025 tax year, a major change is taking effect. U.S.-based crypto exchanges will be required to issue a new tax form, Form 1099-DA, to both you and the IRS, reporting the proceeds from your transactions. This new reporting requirement dramatically increases transparency and makes it virtually impossible to hide your crypto activity. In conclusion, navigating U.S. crypto taxes is a formidable challenge. The key risks are misunderstanding what constitutes a taxable event, failing to keep meticulous records, and underestimating the IRS's commitment to enforcement. The price of participation in this ecosystem is compliance. In our final chapter, we will bring everything together to discuss how to build a holistic risk management framework and a sustainable mindset for engaging with this revolutionary but hazardous technology. Thank you for listening. Hello, and welcome to the final chapter of our series. Over the last 14 chapters, we have embarked on a comprehensive journey through the complex and often treacherous landscape of cryptocurrency investing in the United States. We have dissected risks layer by layer, from the volatility of the market to the code of the technology, and from the fallibility of our own psychology to the certainty of taxes. Now, in our concluding discussion, we bring it all together to forge a holistic framework for managing risk and cultivating a sustainable mindset. This final chapter comes with our most important and final disclaimer. This entire series has been produced for educational and informational purposes only. It is not and has never been financial, investment, legal, security, or tax advice. The world of cryptocurrency is exceptionally high risk. We have not endorsed or recommended any asset, platform, or strategy. Any decision you make to participate in this market is your sole responsibility, and we strongly urge you to consult with qualified, licensed professionals before taking any action. Our journey has shown that risk in cryptocurrency is not a single, monolithic thing. It's a multifaceted web, and a responsible participant must appreciate all its interconnected layers. We've seen the raw market risk of extreme volatility, and the powerful influence of macroeconomic risk from the global economy. We've explored the foundational technological risk of smart contract bugs and network vulnerabilities, and the platform risk of exchange failures and bankruptcies. We confronted the insidious human risk of scams, the powerful narratives of social media influencers, and the deep-seated psychological risks of our own cognitive biases. And finally, we faced the unavoidable legal and tax risks that come with operating in a regulated country. Understanding these risks is the first step, but how do you translate that knowledge into a coherent approach? It begins with building a personal risk management framework. This is not about a formula for success, but a set of principles for survival. The first principle is proportionality. Given the extreme risks we have cataloged, a foundational concept in traditional finance is that any allocation to this asset class should be a very small portion of a well-diversified investment portfolio. The most common and crucial piece of wisdom you will hear is, never invest more than you are willing to lose. It is essential to truly internalize what this means. It means if the value of your entire crypto holdings went to zero tomorrow, it would not materially impact your financial well-being, your ability to meet your financial goals, or your emotional stability. Second is to define your time horizon and goals. Are you participating to learn about a new technology? Are you engaging in short-term speculation? Are you hoping for long-term growth? A short time horizon in a volatile market is exceptionally risky. While a longer time horizon may help to smooth out some volatility, it does not in any way eliminate the fundamental risks of technological failure or eventual obsolescence. Third, embrace the idea that your greatest asset is knowledge. Your most important investment in this space is not in any particular coin or token, but in your own ongoing education. This series was designed to be a foundation, but the landscape is constantly changing. New technologies, new scams, and new regulations emerge constantly. A commitment to continuous learning is non-negotiable. Fourth, cultivate extreme skepticism. Treat this space with a distrust and verify mindset. Be skeptical of hype, of promises of guaranteed high returns, and of influencers creating a sense of urgency. Be skeptical of new, unaudited DeFi protocols. And as we discussed, be skeptical of your own emotional reactions, like FOMO and FUD. Your skepticism is your primary shield. This all culminates in developing a sustainable mindset. This means shifting your focus from prediction to preparation. Trying to predict the short-term price of any crypto asset is a humbling, if not impossible, task. A more robust approach is to prepare for a range of outcomes. Acknowledge the potential, but be fully prepared for the risks we've spent hours detailing. It means separating the technology from the speculation. It is possible to be fascinated by the potential of blockchain, smart contracts, and decentralization as a technological revolution, while remaining deeply cautious and skeptical of the speculative frenzy that surrounds the assets built on top of it. In the end, the world of cryptocurrency remains a frontier. It is a place of incredible innovation, brilliant minds, and potentially world-changing ideas. It is also a place of immense hype, dangerous scams, and catastrophic financial loss. It is not for everyone. The purpose of this series was never to push you in one direction or another, but to provide a detailed and sober map of the territory. Our goal was to help you understand the full spectrum of risks, so that if you do choose to step into this frontier, you do so not with blind optimism, but with your eyes wide open. Be curious, be cautious, and be responsible.
The information presented in this video is for informational and educational purposes only, and is not professional financial, investment, or tax advice. All cryptocurrency investments involve risk, and may result in partial or total loss. You should always conduct your own research, and consult with a qualified financial professional before making any financial decisions. Cryptocurrency investments are highly volatile and speculative. This video does not recommend investing in any specific cryptocurrency. Always do your own research and assess the risks before making any investment decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.